Now, when we are talking about the corporate failure, see how we are going to. Yesterday, before we have wind up the things, we have said that the ability of our skills will be highlighted when we are going to work with those companies which are in financial trouble. Okay, we are talking about the what is the financial reconstruction. Little bit we have to take into consideration now you have to take into consideration the SBL. We are talking about in terms of SBR, and we are taking into consideration the AFM factor. Wherever, whatever we have done, okay, whatever we have done, those things will be interrelated. As per our, see, it is a open platform is there. Is that you have all the flexibility to use your ability to work it out. Okay, now coming back to this. What is the likely response of the capital market? Definitely, most of the companies, people will take loss-making companies. People will take sick industries. Okay, you are in the examination. They will give questions like this. You will take loss-making companies. You will come across sick units. Okay, they are talking about inefficient management. Okay, you will come across something about inefficient management. Okay, you are talking about in terms of the financial support. Banks will not give financial support, is it right? Yes, if they are giving the financial support, there will be very strict covenants will be there. Very strict covenants will be there. Is there terms and conditions? Now what we have to do? How the capital market will react? What the capital market react in terms of very simple, how the share prices will get affected. Is it? When we are talking about the share prices, what is the same concept, future cash flow, is it right? And we are talking in terms of, is it, FCFE, okay? Now, that's what we are talking about, reconstruction scheme. Recommended, what are the reasons? Strategies of unbundling parts of quoted organization. Again, listed organization. Likely financial and other benefits of unbundling. Unbundling means restructuring as per the requirements. Okay, as per the requirement. Is it? Now, in some cases, what will happen? There is a management buyout and there is a management buy-in. Sometimes management is interested. Is that? Sometimes management is interested. They say that if owners are not willing to, not able to manage the business, definitely the management, senior, whatever the management, we are not talking about that. But in general, the management is interested. There are two specific concepts are there. One is management buy-in and one is management buyout. And definitely, we are going to work out with respect to the ratios and trends. Okay, these are the three things. You see the thing. You are talking about the financial reconstruction, you are talking about the business reorganization, and you are talking about the financial formulation strategy. Three basic areas. When we are identifying, when we are responding to the question, we have to think like this. Is that we have to focus on financial reconstruction, we have to focus on business reorganization, and more importantly, we have to focus on financial strategy as such. Okay, three basic things. Okay, now here also nothing is there. Technically speaking, nothing is there. Only the concepts and highlighting the concepts. Okay, the things will start as we start the exam kit. Okay, now we have the thing. What is the corporate failure? What are the financial distress? Read this one again. I'm focusing on very specific things. Okay, you sometimes failure caused by internal revenue failure may be through the loss of orders, through the acceptance or through the acceptance of business which not contribute to the growth of the shareholder value. You will have the cost control, weak cost control. See, we have to take these points, and we have to use it in our answer. Okay, we have to use it in our, so whenever you are coming across, whenever you think that if we are taking any question and you're coming across that this question is talking about reconstruction, before starting a question, you just have a specific chapter, you review it. Specific chapter, yes. Then you will have an idea. They are talking about the changes in is a weak cost control, changes in technology. Now, what's happening right now? What's happening right now? Inappropriate accounting policies, inadvertent or exceptional cost burdens, poor financial management. See, when you are they are giving you any question. Okay, they were in the question. They will be directly. I'm not saying this. They will be directly related to these areas. To these areas as such. Okay, either in some cases there is a revenue failure, in some cases there is a cost failure, in some cases there will be asset management, inappropriate technology, poor working capital management, inappropriate write-offs. Okay, they are talking about a failure in liability failure to manage company relationship with money markets, weak control of interest rate risk and currency risk. Is that what we have done in the interest rates and currency risk? We are very weak country, inefficient. See, this is what happens if you are talking about the financial management. Unsustainable credit work, failure with respect to capital management, poor management relations with the capital markets, and in particular the company debt portfolio. Is a debt portfolio and the optimization of our cost of capital. In problem, see that now you see the things I told you in the beginning. In practice, problems rarely occur in isolation. A business is an internal external worker, so problems in one area may have invariably have consequences elsewhere. Invariably means you cannot say this is it is directly related. It's not like that indirectly related. They are talking in between the lines. It will not work. Okay, it will not work. Result. What are the differences? High cost structure, poor marketing effort, poor acquisitions. Is it poor financial controls? Is it there is adverse changes in the total market demand? Is that change in technology? People are not coping up with the tech. That is the reason why we'll do. People will create provisions. Companies will create a lot of provisions. Is that you have to, when the technology is changing, you have to also adapt to that the current technology. Why companies are planning for 2030? Why companies are planning for 2040? They know. Is it if you have planned and you think in that age, automatically you should have some. Without cash, nothing will move. That without cash, nothing will move. So you have to be very clearly in the reasons. Say that there clearly some of these are not in themselves strategic issues. Much can be done by strong management accounting. Yeah, read these ones. Okay, we have to reduce cost, improve financial information and controls, project management, quality management, without changing the strategy. Okay, this is what they say when we are talking about the strategy. What is the concept of strategy? Strategies you have to change according to the market demands. Okay, strategy is chiefly about adapting the firm to such changes, and strategic failure results when the organization does not change as quickly as the market. Is it as quickly as the market? Is it this is the reason? Now you see the thing. Now see in future if you are going to be there, why companies will recruit young graduates. One of the reasons why you are talking about young graduates means you have to manage the expectations of the market. Okay, you have to manage they will come with new ideas, they will come with the one which can be adaptable, which can be saleable in the market. That is the reason, is that if you take into consideration these factors, it means they are talking about the financial distress. Very very important, very interesting one also was a who founded own company producing automotive parts. Success enabled him to diversify a wide range of components, eventually assembly and unbranded products. Many households are entirely unaware that the product that identified by an expensive foreign brand can be made locally. Many of the, see what they say, are entirely unaware. The company floated and attracted opinion. New investment was used to launch several new projects. The latter was particularly well received with his photo. Made normal a minor person for the means he got the recognition. Public speaking work took a great part of time and company size increased by more than 5 times. Yesterday we have covered this thing. You have good assets, but you don't have a we should have a combination of tangible and intangible assets. This is the one of the reasons where the companies will fail. Okay, companies will fail. They give you a good example. Is this a corporate failure? Read this one. Without reading, we cannot understand the answer. Okay, they are talking about norm. See, he was aging. He is becoming old, unwell, and thinking about it for several years. CEO has been somewhat peripheral, and he was aware that his middle level men was spent some time fighting each other. In the past, there has been such problems with his forceful personality. In the past, he has seen of such problems with his forceful personality, the geographical spread of the company, and the proliferation of made it extremely hard to keep the issues clear in his mind. The company, see, this is the why companies will fail. Okay, companies will fail because of inviting. Why we are taking? See, now more than quantitative. Is that now you see? You be very clear. More than quantitative. More than calculation. Is it what happens? You have to focus on qualitative, financial qualitative. Okay, that's very very difficult one. Okay, you have to think in terms of financial qualitative. The approach has to be like this. They are talking of the company information was not good and dividends loss, manufacturing plant was old, needed replacement. A widely circulated report suggests that export initiative has never been profitable. It has been, see, what we'll do, we calculate return on investment. Is that important one? Is that in these cases what we'll do? We'll talk about mostly what is the ROI. Okay, when investors and lenders wanted to feel that normal was still control. Is that read this one? A very small response, but it gives you a good reason to answer our questions. Is that the problem has been arising in several ways, but it is likely that the formerly dramatic leader has lost his touch, leaving the absence of, this is very important, leaving the absence of strategic thinking and energy. You should have succession planning will be there. Okay, now you will ask why we are talking about HR here. Is that why we are talking about, but without HR it will not work. Is it right? You should have a succession planning, replacement of the CEO. That is the reason we will say what we'll do. We will see you will say it is a deputy CEO. We will say there should be a clear hierarchy has to be there. Is that this is what the financial concept of a financial distress. What are the factors will lead a company to a financial distress. Is it financial? You are doing a good financial planning. You are doing everything good. Financial planning is everything perfect. There is no flaw is exist in the financial planning. But subsequently, we cannot say that all are. They say invariably will have impact on the organization. Is that what? How? If you take from the quantitative point of view, definitely the simplest one is the ratios. There is a free cash flow analysis. Okay, these are the financial distress. We are talking about the very different forms of ratios. Okay, very different forms of ratios. We will do this. Okay, in the examination also, whichever is relevant, whichever is most specific, we can do. We are dividing it into different categories. Okay, we are talking about statement of profit or loss gearing. Okay, this now you are very clear. It's not like a general part we are talking about. We have a stock market ratios, we have a statement of profit and loss gearing, interest coverage. Okay, the other things are same. Okay, liquidity, profitability, and these are the only two sub classifications. Okay, now they have given a small question. Fine, is that we are talking in terms of 2007 and 2000. What they are asking us, performance analysis, ratio analysis. Okay, performance analysis, ratio analysis based on the formulas given. Okay, based on the formulas given. Okay, you hold it, nothing will happen. Okay, assessing the corporate failure. What are the other failures? Okay, what are the other considerations? Is it the ratios are not only good indicators of performance? Fine. Uh, this is that the information is published. You should not think that ratio analysis of published accounts and free cash flow are the only ways of spotting that the company might be running in finance. The possible reasons, sum of information, worsening cash and cash equivalents, huge contingent liabilities, post balance sheet events. Okay, what are the commitment? Information in the chairman report and director reports, fine. Information here, information in the press, information about the environmental and external. Yeah, now the expectations and the response will be at a different level. Okay, at a different level. We have to extract the information. They will say in the media it has been published like this. They will mention what is the chairman's report, what is the director's report. Like that we have to analyze. The most important thing is, see, now you will be surprised to know this. That's what it says. We are not mentioning this. I don't think so we will mention, but they are giving you a concept of a ISA 570. Is that the concept of a ISA 570? Now you should understand what is that is a going concern. Okay, what are the reasons for going concern? Okay, what are the reasons will be going concern? You are approaching a bank. Bank is holding your loan. It is a going concern. Is that you are not in a position. Your reserves are less. You are not going to support your financial operation for the next 12 months. It is a going concern issue. Is it? This way we have to make sure that link the concept. Ultimately, at the end of the question, at the end of the question, we have to mention. Okay, we are not going to mention going concern. We are going to mention the cash flow position, whether the company is going to sustain or not. But there are major things, restructuring of the debt, indications of withdrawals of financial support from the data. So I'm taking randomly, okay, adverse financial ratios, inability to comply with the terms of loan agreements, okay, overdue of creditors, inability to pay creditors, okay. These are the various things, fixed term of fixed term borrowings approaching maturity without realistic or renewal of repayment. Excessive reliance, okay, excessive reliance on, these are the things, these are the points which we have to use. Again I'm saying this, okay, the excessive reliance on the short term borrowings to finance long term assets. People, what they will do, people will borrow, okay, people will borrow. That is the reason what you will do, you will think in terms of an overdraft. Overdraft facility is there, fine. Overdraft facility is used effectively, fine, that's good. But overdraft, if the overdraft facility is overdue, keep it in mind. If the overdraft facility is overdue, then it is a finance. It is a one of the indications that the firm is in financial distress. That the firm is in the financial loss of key staff, without people will start leaving. Okay, excessive dependence on few product lines. You have to good product width and product depth will be there. So that you should have good what I can say, a good line of products and services, technical developments. These are all the things, and it's very easy. Clear, keep it in mind. It is very easy to, the moment you study, you read the scenario, the so many points will trigger in your mind. So many points will trigger in your mind. With your experience, real-time experience, practical experience, you will come across a very easy approach for this. Okay, they are talking about the things. Now, corporate reconstruction, little bit more new one. Okay, new one. In a, companies in financial distress often undergo corporate restructure, construction, to remain them in the business rather than liquidation. Corporate restructuring in a failing companies often involves raising some new capital. Sorry. Is it? And you are persuading the creditors or the lenders to accept some alternative. This will ensure corporate business continuity. As a banker, you know, people will come. Okay, if credit risk, clients will come. Clients will come and give reasons that you have to reschedule the loans. That you have to reschedule the loans. Okay, definitely in some cases you will reschedule. Is it? In some cases you will. In some cases you will reschedule. Is it? See, they are coming with a very positive mind. They want to be in the business. That is why they are approaching. Okay, that is why they are approaching. If they don't want to be in the business, they will not approach. Okay, they will not approach. So that is why how we have to give them solution. Longer term, the management needs to consider whether reconstruction helps the company to have a sustainable competitive advantage and provide opportunities for raising further finance. Is it? Now, options open to failing companies not wishing to go into liquidation, which allow the development of, see, what is the company voluntary arrangement? There is an administrative order. There are new things, new concepts, okay? This is legally binding arrangement between the company and the creditors, legally binding. It may involve writing of the debt balances on the profit against shareholder capital and creditors capital, therefore affects creditor rights. See, it is a legally binding. Very slowly think about it. It is a legally binding arrangement between company and creditors. It may involve writing of the debt balances on the profit and loss account. Against what? Means against the shareholders' capital. means when they are writing off the things, the shareholder capital will decrease proportionately. How it is designed to see, it is designed, what we are doing, it design means you have to pay off your creditors, okay, means you are paying the creditors from the share capital. See how extreme situation it will go. You are paying the creditors to your share capital. That it is designed to ensure that return to shareholders, return to creditors is maximal. It is useful in companies under pressure from cash flow problems. After some time, even banks will not entertain. After some time, even what will happen? You will say it is a limited liability company. You will say it is going to be it is a listed company with the liability of how much we have invested. But what will happen ultimately when there is a restructuring? Is it voluntary arrangement? We have to make sure that we have to give they have to give from the pockets of the shareholders. It is through, see, application is in the court. We are not writing this. Again, I am saying where we are mentioning, where we are not mentioning. Is it? We are concerned about this. Okay, we are concerned about this. Yeah, we are concerned about that. That's what it says. Is that there are various things. How if we go to a legal, if you take a legal process, okay, if you to go to a legal process, there will be the scheme of restructuring is fine. All those things will happen. If court sanction, then it is a binding on all the creditors to abide the thing. Administrative orders to allow space for recovery plan to be put in the company directors. One of the creditors will apply for the order. The company continues to trade where plans are put in place to rescue the company and achieve a better return to the creditor. Administrative orders, in other words, an external legal entity will get involved, okay, and it will not be in the hands of the management. It will be the operations, the control will be in the hands of the external party. Or in other words, if board of directors, if 5 board of directors are there, then there will be 3 board of directors appointed by an external body. They will act as per the guidelines given. The use of considering the case of manufacturing company, which has become insolvent. There are indications of poor credit control. They are talking about the long lead times. So what are the reasons? The company was put in an administration to allow recovery plan. A new arrangement was brought in which production and financial might turn around for the company, which is now profitable. The management will change. Okay, the management will be changed. Is there for a better way out? Okay, for the better way out. Okay, one time reading. Wherever I am putting the star mark, it is related to our response. Other things, one time reading. Okay, corporate reconstructions can also be undertaken by successful companies. It is not only the failure company. What is the objective? To reduce the net of cost of borrowing, to repay borrowing sooner. In some companies there is zero debt companies are there. There are some companies which have a zero debt policy. Security of the finance, it looks more attractive to improve the image to the third party is fine. What are the options? Okay, what are the options? See, there are 4 main types of reorganization. That conversion of debt to equity. You can convert the debt to equity, zero debt policy. Conversion of equity to debt. You are pledging the shares. Conversion of equity from one form to another form. You are converting equity from the ordinary shares to preference shares. Any other combination. conversion of debt from one form to convertible bonds will be there. Is there convertible bond? Any specific characteristics. Okay, they are given you the various things. Okay, they are convertible debentures exercising their rights. Okay, automatically. Read this one. Okay, wherever it is possible, making shares the conversion of equity from one form to another, making shares more attractive to investor. For example, subdivision into smaller units or conversion into the stock. Devising a corporate restructuring scheme. Will take as per the requirements. They have mentioned so many things here. Okay, they have mentioned impact on the shareholders. A restriction only be successful it, if manages to balance the different objectives. The solvent, what are the different stakeholders? Solvent companies often enter restructuring schemes to improve their ability to raise finance. Banks have been criticized for in the past for being too quick to close down falling units. Okay, if there is a failing unit, is it? If there is a failing unit, you should not come to a conclusion. You have to give them chance to for revival. Okay, you have to give the chance for revival. Trade creditors Trade creditors may also agree to a reduction if they wish to protect a company which will continue to be customer to them. Okay, these are the so there are so many reasons. Is that preferential gives holders a preferential right for repayment of capital on winding up. If preference shares are expected to suffer some reduction in the nominal value of the capital, they may require to increase. See, we have not done much enough with respect to preference shares, okay? And basically, if you go in detail, they have not covered, to my knowledge, okay, to my knowledge, preference shares are less focused, okay? Now, have you done this? By incorporating these points?
No.
Yes, okay, oh, fine. Now, what they are saying, I will explain you I will explain you, okay, we will discuss. Show the likely position of key shareholders, ordinary shareholders, okay, ordinary shareholders, preferentials and debentures, if the firm goes into liquidation. Is it? What is the liquidation? You will pay off all the liabilities and see that what is the position of the key share, how much they are going to get it back from there in terms of investments. Is that in terms of investments? The investment is sold at the current market price of how much? At current market price of 60,000. 10% of the receivables is a return of. The remaining assets were professionally valued 80, 80, 30, and 50. One second.